The next red flag to go up is when the Federal Reserve and other central banks come in and buy again. And then the next time, that is a very risky point, is when we have the next economic downturn. What we have done, my generation, unfortunately, has allowed debt to build up, has allowed infrastructure to deteriorate, has instead borrowed forward. And so if we think about what this debt restructuring and renovation is going to cost, and we think about that's not measured in money, money just produces productivity. So the work and how we're going to have to be in order to be effective has to overcome that deficit for this giant renovation. So we haven't done it, but it's very simple. There are debtors and there are creditors, and the system has got to work well for both. One man's lending has got to be rewarded to compensate for making that lend. And so you have a process. If you accumulate debt, you are accumulating the need to pay back in real terms. You have to pay back the principal and you have to pay back the interest in real terms. Otherwise, nobody's going to want to lend and the system doesn't work. And the two issues that you have a choice of is to pay that back in hard money. In other words, money of value that's of comparable value, or you have to print money and you pay back in deflated money. And so what has happened over a period of time throughout history, these cycles, by the way, go back to the Old Testament, years of Jubilee, and the same cycle always happens. And there's a tendency for debt to rise relative to incomes that are needed to service that debt. And so you see different societies. In our society, we have high debt service costs, which then will rise as we have large deficits and large amounts of money to pay back. And if that balance is not well achieved, so that the creditor does not receive an adequate amount of compensation, they will sell that debt. They will not hold that debt. And so it's not just the amount of new debt that's created. It is also the amount of debt outstanding that could be sold and therefore create a huge imbalance between the amount to be sold and the amount to be bought. And so in history, it's all repeated in the same way. When that time comes where they have to do that, when they do that selling, and central banks come in and they think they're saving something because they're printing the money in order to pay back the debt as has been done, monetization as we call it, that creates a bad compensation and devalues money. That's the mechanics. So there's no getting it around it. Wouldn't it be wonderful if it was like that debt didn't matter and you could keep borrowing? But think of it as just you're borrowing a proxy for stuff and it has to be paid back. What happens, and Japan is the worst. So what Japan has done is by printing a lot of money, they have had their currency go down. And so that currency decline is the way it's depreciated. So if you have a bond holder in Japan, they've lost about 80% of their value in their purchasing power. And that becomes the dynamic. That's the same sort of dynamic. So the next thing I think that you're going to see in the United States is you're going to see a squeezing of consumption. So at the federal government level, as the debt service payments are rising and the debts are rising on those, you're going to see the squeeze. There's very little room between entitlements that are fixed payments and the actual revenues that are coming in. You're going to start to see that squeeze. The real issue will become if you start to see the selling of those bonds. When exactly that happens, I can't tell you. The next red flag to go up is when the Federal Reserve and other central banks come in and buy again. And then the next time, that is a very risky point, is when we have the next economic downturn. And I think that probably will be within the next 4 years. Cycles, the business cycle lasts about 7 years on average, give or take 3 years. So I can't tell you exactly when it will be, but I would say it's probably most likely within the next 5 years, something along those lines. I think a combination of gold and inflation index bonds would be good. I think that gold also has the benefit of being uncorrelated or by and large, almost negatively correlated with other assets. So it's an effective diversifier. So in thinking of stocks and bonds and so on, if you bring that in, actually you'll lower the risk of the portfolio. So it's very good from a portfolio construction. It's also as a war option. In history, when we have wars, nobody wants to lend to anybody. Even allies don't want to lend to each other because everybody gets in much more debt, and they know that that has to be devalued. And the question is, what is the common currency? I think the world is leveraged long assets. That means, generally speaking, most assets are leveraged long. I think when they print money, that'll be supportive to some of those assets, as they always do. But I would expect an environment that would be more like the 1970s or in the 1930s, in which, in terms of real terms, that equities does poorly relative to, let's say, hard assets. When you think about what is an alternative money, gold is the third largest reserve currency. Central banks are now buying it. I think that also in institutional portfolios and in individual portfolios, they're underweighted. Inflation hedge assets are. So I would say, my flyer, even though I believe so much in diversification, so I would say I would diversify more. But if I was to say, what is it? It would be not just gold, but gold in combination, particularly with some of the inflation index bonds, because gold and inflation index bonds are only 16% correlated. And so they balance each other well. And they're both, over the longer term, relatively good assets to hold in the kind of environment that I think is more probable than is being discounted and that I worry about. So it would be an effective diversifier. And by the way, I would say, people get fanatical about Bitcoin or they get fanatical about gold. And I think that they have to think more broadly when they're thinking about what is the form of non-debt money. The Bitcoin issue is, I believe that you're not going to get privacy in Bitcoin. Governments will follow and so on and can tax and control however that works. And if an alternative money of any form is threatening to the system, they can shut it down, they can operate in that way. And that the behavior of Bitcoin in terms of its determinants, past behavior of Bitcoin, doesn't make it clear to me how it behaves in relationship to some of these determinants. Bitcoin is also, just to put it in perspective, it's a relatively small market in terms of, it's like a fraction of, a fifth of the size of Microsoft or something, one stock, and there are many stocks. So for all of those reasons, I wouldn't heap a lot of money into that. I have a very small Bitcoin position. For those reasons, I would say central banks are not themselves going to take on Bitcoin. Central banks are going to take on, there's a saying, gold is the only asset you can have that isn't dependent on somebody else making you payments. So I would favor gold over Bitcoin for those reasons, but, each to their own, and, make sure you're diversified, because if the type of environment that we're talking about that, comes to pass, you better be able to turn it into hard buying power wherever you want and probably have it fairly private. I think that's crazy. And I think I've been in the markets for 60 years, and I've been through many, many cycles. And I know that wonderful technologies, with large changing of the world technologies throughout history, and I can go back to the steam engine and carry it all the way through, they all have a cycle, and you also don't know who the winners end up being in that cycle. And there are enormous amounts of risk in that dynamic of operating that way if you want to keep money as a storeholder wealth. The holy grail of investing is to find 10 to 15 good, uncorrelated return streams, because if you find a number of return streams, a number of investments that are good and uncorrelated, you will have the average return of those. So you don't lessen your return. Just pick ones that are really, really good that you like, but they're not correlated. But you will eliminate, at 15, you'll eliminate 80% of your risk. So you'll improve your return to risk ratio by a factor of 5.